This program is brought to you by realestate.com.au, Australia's #1 address in property. With more properties for sale than anywhere else, we make it easier.
Welcome back to the program. Let's take a look at the auction markets around the country this week. In New South Wales, there'll be 647 auctions. 520 of those are in Sydney. In Victoria, there'll be 593 auctions, with 554 of those in Melbourne. Queensland will see 219 auctions, with 103 in Brisbane. South Australia will have 108 auctions, 98 of those in Adelaide. And WA will have 18 auctions, with 14 of those in Perth. And as for Canberra, there'll be 90 auctions that will take place this week. But let's take a look at some of the top viewed auctions, starting in Victoria with 60 Park Street, St Kilda West. This is a 5-bedroom, 3-bathroom house on 560 square metres. Key features are the high ceilings, natural light and grand proportions. The price guide is $4.9 to $5.35 million. Over to New South Wales, 47 Clearfield Avenue, Austral. It's a 4-bedder, 2-bath house on 316 squares. It's modern with a free-flowing floor plan, and the auction is this Saturday with no price guide advertised. 4 Kirkwall Court, Glen Waverley in Victoria, a 4-bedroom, 3-bathroom house on 740 squares. It's in a quiet court just steps away from a big reserve. The price guide is $1.2 to $1.32 million. Also in Victoria, 1A Myrtle Grove, Blackburn. It's a 3-bedroom, 2-bathroom, 616 square metre house. The gardens are the feature of the property though, with well-manicured flower beds surrounding. The price guide between $1.6 and $1.7 million. And over in New South Wales at 3 Kinley Place in Baulkham Hills, there's a 4-bedroom, 1-bathroom house on 700 squares. It's got loads of opportunity to add value with R3 medium density zoning. The price guide is $1.2 million. But this week's top viewed listing is 14 Yellow Gum Drive, Ocean Grove in Victoria. It's a vast estate on 4,500 squares set in a tranquil bushland setting. It's got 5 bedrooms and 3 car spots with multiple entertaining spaces, even a series of secret rooms. Outside is a dream for entertaining with an alfresco deck, a 25-metre indoor swimming pool. There's also a barbecue and a pizza oven as well. The house has got it all for the kids too. A pirate ship in the backyard, a slide into a children's rumpus room. And it's expressions of interest with a price guide of $4.5 to $4.95 million, with interest closing on March the 9th. Well, today, REA Group released its half-year profit down 9% to $205 million. It says that listings fell on a national basis, but it's increased its yield in its advertising products. A little earlier, I caught up with REA Group's Chief Executive, Owen Wilson.
I think it's going to stay where it is for the remainder of this financial year, but I think we're going to see a calendar year of 2 halves. What we saw in the first half was definitely after 8 consecutive interest rate rises, sellers decided to pause and buyers had to adjust to their low borrowing capacity as interest rates rose. And that's continued into January. We think that'll continue over the course of this financial year, given we know there are probably 1, 2 or even 3 more rate increases. But then as we go into the second half of this calendar year, we get closer to the peak in interest rates, I think we'll see a big increase in activity, and particularly year on year, we'll be cycling some very low listing volumes in the second half of this calendar year. So it'll be a tale of 2 very different halves.
Yeah, I mean, obviously tough to forecast, but what's your base case on how much more property prices could fall this year?
Look, our internal projections for house prices is a further 7 to 10% drop in prices. And what you're seeing there is sellers are coming to market. There are still buyers there. We saw it in our numbers that the buyer inquiries in the first half of this year were still up 14% on pre-pandemic levels. So buyers are still there, but their capacity to pay has been diminished by the rate increases. So what you'll see is sellers who come to market are going to have to meet those buyers' limits, and therefore prices will continue to fall. And as we're predicting, another 7 to 10%.
It's interesting though, listings obviously sitting online for longer on average, and perhaps vendors have to buy premium products to try to get increased engagement, to maximise price in a falling market. So how does this dynamic actually play out for the business? Is this in a sense a positive?
It is, yes. People are looking for their marketing dollar to go further, and so we saw a very healthy uptick in our premium products as people are looking to get maximum exposure for their properties. Days on market have blown out about 10 days, but they're not extraordinarily long. As I said, people who are bringing their houses to market are getting a result, provided they're being realistic on price and meeting what the buyers can pay.
You're over and above your competitors in terms of monthly visits to the website. You've also had strong residential depth penetration. Why do you think it is that you're growing market share in this uncertain environment, and do you expect to continue that as well?
Oh, we're delighted with our audience levels. They've come off from the peak last year, but we still have about 12 million Australians coming to our site every month. And over the past 3 years, we've almost doubled that to 2.5 million people coming per day. I think it says volumes for the consumer experiences that we have. We've got a lot of property data on our site. A lot of vendors come to our site and claim their property. We've now got 5 million properties claimed on our site. And you get a lot of insight into your property's value, transactions in the market, and I think that is continually driving more consumers to our site.
One part of your results that was interesting was core operating costs. They've obviously increased. What's driven that? How do you plan to mitigate costs this year? Is it predominantly through headcount?
Yes, we did see a 7% increase in costs in the Australian business. That was largely due to wage inflation, and we also continued our investment into new product. But as we turn into this new calendar year, we have signalled that we do intend to reduce our costs over the course of this half. Most of our cost, the largest proponent of our costs is headcount, and we are lucky in that we have attrition in our business, so we can reduce our headcount merely by slowing down hiring, and we will do that over the course of this year.
Okay, I want to take a look at some of your strategic investments, Mortgage Choice in particular, its integration in final stages. What are you expecting in that business, particularly as we've got a couple of dynamics at play? We've got the fixed rate cliff nearing, you've got a bunch of refinancing taking place, but on the flip side, you've got mortgage prisoners, perhaps less people going for new loans, defaults. How does this all play out net for that business in particular?
Yeah, this market presents some headwinds for the Mortgage Choice business and some tailwinds, as you said. On the headwind side, with interest rates going up, borrowing capacities have fallen, and therefore average loan sizes have come down. Also, a large part of the market is people transacting in property and getting new finance to that, and so with transaction volumes down, that's also a headwind. And then the third thing we're seeing in terms of headwinds is that people are taking their excess savings and putting it on their mortgage to compensate for the increased interest rates. On the flip side, as you said, we are approaching a huge wave of refinancing, particularly around April, May, June, as a lot of people will be converting from very low fixed rates to variable rates, and we see a huge opportunity in helping those consumers find a better deal.
Just quickly as well, a couple of economists are forecasting rate cuts as early as this year. Obviously, it's anyone's guess at the moment. But how price sensitive or how sensitive are listings to interest rate rises or cuts at the moment? I mean, if we were to see cuts this year, do you quickly see an upshoot in listings, or is there a bit of a lag for consumers? How does that work?
I think there is a direct correlation, and particularly when it's uncertain. I think that the uncertainty impacts listings more than the actual rates themselves. So while interest rates were going up month on month for 8 consecutive rate rises, that uncertainty caused a lot of sellers to pause and a lot of buyers having to reevaluate how much they can afford to borrow. I think rather than interest rate cuts, once we are clear that we're at the top of the cycle, and I think that'll be around about the middle of this year, that's when consumers will come back to the market and that'll drive activity. If we get rate cuts or there's a signal of rate cuts, that'll have an even better impact.
All right, Owen, pleasure to have you on the program. Thanks so much for joining us here.
Thank you, Ingrid.